Well, good afternoon, everyone. Hope you're having a great day today. Today, I want to thank ParadigmNEXT for hosting this web seminar. Today's discussion, what I'm going to do in the 30 minutes allotted for the presentation, I'd like to present to you some factors that influence the interest that angel investors may have in investing in your company, your startup. If time permits, before the 30 minutes, I'll also just briefly talk about convertible debt, which is the most likely form of financing that you would obtain as a startup. To set the stage for you, and in terms of how you should be thinking about what I'm talking about, key takeaways. First off, the pitch has to be a wow. I've seen many, and I mean way too many, dull, uninspiring pitches where with a little bit of effort, a little bit more time and energy, people would be going like, wow. Remember, the goal of a pitch is not to convince an angel to invest in you that instant, but rather get them thinking, wow, I really want to be talking to these folks. This is really intriguing. It's a way to get them to get together afterwards, where you can spend a little bit more time and energy of getting into the details of your situation. Second, be very self-aware and reflective. That's about you, your team. Do you instill confidence in a prospective investor? If you are not the best pitch person, make sure you have a team member who can. It's okay as CEO or the high-level strategist. Not everybody is a salesperson. Not everybody has the same presence. Be in a position where you can take a step back and let other people lead it. Again, that'll get you to the wow. It'll also help investors say, this person knows where their major strengths are and where their weaknesses, and they're bringing in the right people to get the job done. A lot of times when I meet with startups on one-on-one meetings, or even in a pitch event where I may be judging, most of the time, like 90% of the time, I find that the business model, the go-to-market strategy does not match, and they don't know that's going to be required. So be very aware of that. Work with some people in advance before you start formally pitching. So keep that in mind here as we go through this. And then the fourth item, key takeaway, choose who you pitch to very carefully. Talking to the wrong investor is a waste of everyone's time. And we'll get into that a little bit more in more depth. At the end of the 30 minutes, give or take, I'm going to open up the ability for people to ask questions. Feel free to type out questions as it goes along. Unless something grabs my attention that I want to address right then, we'll hold those off to the very end. Okay? So what factors impact an investor interest? I think most of you, or a large number of you, have heard the jockey-horse analogy that's been applied. I've actually taken that and expanded it. What I have found that analogy works really well, but it stops short when you stop at the horse itself. So I look at it from the jockey, the horse, the racetrack, and then at a recent event where I was giving this kind of talk to angels, the comment was made to me, or the question was asked, well, what do you think about the overall economy or the stage that we're at on a world level? How does that factor in? And so we consider that market conditions or the track conditions. The other dynamics, financial dynamics associated with it, the exit itself, and then does it fit their investment framework? And again, I'm going to emphasize that last point. It'll save you a lot of time and energy and increase the likelihood somebody's going to say yes. So I'm going to step through each one of these, and again, if you have a question, a comment, feel free to type it in, and we'll capture those, and I'll answer as many as I can at the end. So what about the entrepreneur, the team, the jockey? In my book, it's the single biggest hurdle. And I think in general, unless it's your parents who are investing in you or family, it is going to be one of the biggest hurdles. I hear it over and over again, and I've walked away from many a deal situation where that the entrepreneur or the team didn't really pass the hurdle. What does hurdle mean in this particular case? Well, certainly trust and ethics come into play. It's almost a given that you have to be trustful, you have to have the right ethics. But surprisingly, ethics goes beyond that, what you would standardly apply. I had a situation where I met he wanted me to join and so I did some contextual framework as to how my involvement would be. And what I found out subsequently is that he had prior founders that he removed from the organization without leaving any equity to them. He negotiated with early investors, did not give them the time of day that they were required. Basically, his ethical footprint was not where it needed to be, and I realized that if we put money in, that we'd be secondhand as soon as he got the money. Past history of you as an entrepreneur or as a company leader or otherwise is highly valuable. Experience in the market. Many a time we find individuals who have a great idea, they don't really have the experience in the marketplace. And that doesn't remove you from being able to be funded, but it certainly helps when you have a team member yourself or you have team members who have some experience in the market. It's much, much faster. If you're a B2B type play, that you've got connections to companies within that marketplace, VP of sales, VP of marketing, whatever may be the case, it helps you get that early adopters, those that you need as referenceable clients. If it's in a consumer marketplace, certainly if you have a team member that has experience in consumer marketing or otherwise, or you bring on to your team organizations like ParadigmNEXT to help you there, then that's great. Coachability. A lot of people, there are very few situations where I'm going to look at the founder, the team, and go, you know what, they know everything that needs to be known to go forward. I have complete trust in them, and I'm going to take a very hands-off approach. So coachability is usually the opposite. It's a situation where I recognize that parts of the team, they may be lacking certain skill sets or otherwise, and coachability then comes into play big time. That doesn't mean that you're going to take my advice or other advisors or board members' advice, just completely. What it really means is that you're willing to listen, that you're willing to turn around and evaluate the situation, evaluate the advice that's being provided, and then come back with a reasoned perspective as to what's going on. You may decide not to ignore that advice, and you should be able to articulate the reasons why. You may decide to take that advice but modify it a bit, and again, reasons why. You may determine that it is the right advice and that you should go forward. To give you a sense of a company that I have invested early on, providing the particular service that he was offering as a software as a service on a monthly fee. And I basically said, I don't think that makes a lot of sense given what kind of the end deliverable that was. I suggested that he take a look at pricing it per unit, and he kind of looked at me askance at the time, but said, okay, and he did. He went out there into the marketplace, about 90% of the people said, yeah, absolutely, we wouldn't do it as a service or less likely to, but instead we'd rather pay for on the deliverable basis. And in the process of doing so, it more than doubled the total addressable market. So listen to the advice and counsel. Be prepared to think about it and get back to the person and provide some cogent response. And guess what? In the minds of the angel, you're going to go up a notch on their fundability scale. So what about the idea? Well, it's really rare, quite frankly, very rare, that I ever run into an idea that doesn't sound great. By the time it gets to me or to a pitch event or something, the idea probably is reasonably vetted. But the idea is more than just that. It's got to be around the product that it is, what market it's going into, the industry or vertical, if it's a functional activity like marketing, or is it industry focused like the restaurant industry? What's the size of the market when you ultimately get out there? There's a big difference, and I see this all the time in the pet industry in particular. People talk about the 50, 60, whatever billion-dollar pet industry there is. Most of the ideas that I ever see are not related to the entire industry. They're a component of that total industry. So it immediately turns me off when somebody says, you know, there's a $56 billion pet industry, and that includes everything from dogs, cats, horses, hamsters, whatever. And the product or service is specific to dog walking. Well, that's a much smaller market, and you know, trying to present it as it's this big, audacious, multi-billion-dollar market, it's very quickly going to cause me to say, you know, they're being unrealistic. They really don't understand what the market is. So come with a great idea, but it has a very big impact on the fundability of your venture, and it's got to fit the style of the angel investor themselves. So we're talking about one more strategy. I start a little bit from what most people talk about, just the jockey and the horse. So most often you have a specific business model, and only in a few cases or specific situations you might not have the business model yet created. And when we talk about business model, is it software as a service? Are you charging? Is it B2B, B2B2C, B2C directly? How does the company generate revenue? What is the profitability? What are the gross profits? And remember, the gross profit and gross margin is very different than net profits. I see many a business that ultimately have a very small gross margin. They're very hard to finance and fund because any mistake is hard. You're going to lose money very quickly. So be sure you understand your own direct business model. One of the best parts about software and software as a service is that, generally speaking, the business margins and the gross profit available is very, very high once you build it. You spend a lot of capital expense up front to build the application, but the actual next user, almost all of the revenue goes to the bottom line, and that shows the ability to scale. How will you obtain the customers and clients? There's a lot of situations where it's a two-sided market. It may be a three-sided market, or it may be just a single one-sided market. Those are very critical in the standpoint of how much money you're going to need. When you think about the consumer marketplace, why do you think companies raise tens of millions of dollars after they've gotten a little bit off the ground, or $100 million to continue after they've gotten a certain point in time? Because on a consumer marketplace, you have to have an incredibly large amount of marketing spend. In the case of B2B, however, if you're going after tier 1, tier 2 companies in a particular market vertical, guess what? You may be able to just hire 2 salespeople, 3 salespeople, 3 biz dev people, and be able to get the right level of activity. So it's very interesting, very important for you to have a very clear understanding about what how you're going to obtain those customers or those clients. I distinguish here customers being generally consumers, clients being generally business, B2B. It's just a personal differentiation that I use. So market conditions. Now, again, this came up at an actual pitch event, or I should say an angel seminar that I was putting on, and one of the angels said, "Well, what do you think about it? Recession, track conditions. What about when things are going on the external marketplace?" And quite frankly, there are a lot of factors associated with it. Number one is if you were out in the marketplace during 2008, 2009. Tell you what, very, very hard to find the funding. Even 2010, it was a bit on the difficult side. Why? A lot of people were licking their wounds. A lot of people had lost tremendous amounts of their personal wealth. Did it mean that you couldn't get started? Absolutely not. Some of the best companies that are out there were started in the 07, 08, 09 type of time frame. But it does have an impact. It does reflect the degree of difficulty that you're going to have with regard to getting there. Your product, your idea, is it part of an emerging market? Is there wind in the sail, so to speak, and figuratively and literally, is it there? Are you then on the front end of the growth curve? Are you on the saturation level? Is there a market contraction going on? It doesn't mean you can be at any part of the curve, and you could still be very attractive. But the pricing, the value you have to provide to that customer is going to be different. You'll have to prove to the investor that if you're on the back end of the curve, that you have a valid reason for attacking it, and that you're going to be able to grow a business that's going to provide an adequate return to the investor himself, him or herself. Elasticity of demand comes into play. In other words, what kind of pricing pressure you're able to provide. If you think about it, if you have a regulatory situation occur in the midst of, regardless of the situation of the overall market, if a regulatory condition comes into play, generally speaking, you're going to have pricing capability if you address that regulatory issue. There's a recent thing going on right now that in the credit card marketplace, there's a new chip-enabled requirement that starts October 1st, and so we're rapidly approaching that date. And those who sell chip-enabled readers are seeing a fair amount of demand, even though most restaurants, most organizations that would have to use it, the last thing they want to do is spend money on a new reader, credit card reader. But because of the regulatory pressure, or in this case, the rules that are being placed in front of them, they're spending the money. Financial dynamics. This really revolves around the terms of the investment that you're proposing or that you're being told to consider on the part. There's a dramatic need for the consistency with the go-to-market strategy. Failure to match up with that go-to-market strategy, the perceived one or otherwise, is going to be a showstopper immediately. Future funding needs. All too often, people are looking at this first raise and say, oh, I only need $500,000. Well, if you're a B2C, for example, you believe it's $500,000 only because you're going to go viral, think again. Most investors who have any degree of experience are going to go, you're going to have to prove the viral nature of this, and you're going to have to spend still money in order to get it out there. And so therefore, there's going to be a future funding need. And what's that kind of dilution that's going to occur to me as the initial investor? Are you going to be able to sell the next round at a much higher valuation? Are you going to have to raise $4 million, $3 million, $5 million to get out there? So future funding needs, and you need to be aware of what that's going to be. And the perceived risk of performing. Very clearly, a med device company which needs FDA approval has a very different perceived risk of performing They also generally have a much higher return expectation. But if you're a mobile app and you're very specific, or you're a service, those have different risks associated with the perceived risk of how well you're going to perform and how much money is going to be needed to do so. And so that comes into play in terms of the financial dynamics. So what about the exit? There's a lot of people out there who say, put in your pitch deck a lot about the exit. And quite frankly, some investors are very interested in the exit and how you're going to make them money. Quite frankly, for me personally and some of the angels that I work with and even some of the VCs, we don't care effectively. Unless you require a strategic acquisition by a big player, and as long as we can reasonably expect that you're going to hit some level of your projected numbers, we don't care. Why is that? Well, if you require an acquisition by a strategic player where you're going to get multiples of maybe revenue, again, med device is a good example. There are many acquisitions in the $100 million, $200 million, $500 million where the revenue is only $1 million. And why is that? Because the hurdle of getting through FDA approval is so high. And then the strategic acquirer, their ready appetite, because they can take that product and push it into their marketplace, is really strong. But if you don't need a strategic acquirer and you show that hockey stick, and we think you can actually accomplish the hockey stick, you're going to have plenty of revenue. You're going to have plenty of profitability. And if you hit those numbers, guess what? I'll find you an exit, or you'll find yourself an exit. People will come to your door. I've had a number of those recently, have had discussions with others that are hitting their numbers, they're hitting their revenue, they're hitting their profitability, and they're going to be acquired by a financial player or potentially even the strategic player. But the good news is if you can get to those numbers, we're going to find you an exit. And you're going to make money, and I'm going to make money in the process. The one thing I do always want to hear, however, is that I do want to know that you do want to exit. In other words, I've run into, over the course of time, entrepreneurs who ultimately are really just interested in creating a business. They want to run it forever. And that's a problem. Unless there's a mechanism associated with that for me to make my money, then I'm sitting here with a position in the company that you just keep going forward and forward and forward, and I'm not really making my money back. So I am interested to know that you are willing to exit under the right conditions. Had a very interesting early stage situation of a company where I asked in the middle of a pitch, I asked the founder at what point would he be willing to exit within, let's say, the next year or 2 years, what kind of dollar figure. And he thought about it a little bit. He said, that's a really great question. He thought about it. He came with the number. Not only did I like the number that he said he would exit at, but the fact that he didn't hesitate. And that was important. That told me that he was focused on growing the business, but also the ability to exit at some point. So, getting to the gate, continuing the analogy a little bit, does it really fit with their investment framework? You may have all the right characteristics, the things we just talked about. When you run them all the way through, you go, yep, check mark, these really look good, this is great, etc. But even then, most investors, whether they're angels or institutional, they have very specific filters. Okay, that means they will apply their own personal filters on whether you're a good fit for them. You may have the greatest opportunity in the world, but guess what? It doesn't matter if it doesn't fit theirs. So, is it the right stage? Is it the right market or type of business? Dollars being invested, the risk of failure, the return multiple on the exit. So these all go with the things we talked about before. You do not control what those filters are. You can't do anything with regard to who you are relative to those. So don't sweat it from that perspective. Instead, understand who you're about to talk to, or do the homework in advance. And if they don't fit your filters, if you don't fit their filters, I should say, you might be better off to modify how you go into that meeting. One of the things you would consider doing is go in and say, I understand that we're not really an exact fit for you, but what I'd like to do is let you understand what we're doing, and maybe you know somebody who does, who it fits. And guess what? You just changed the dynamics pretty dramatically. If you do fit their filters and you didn't really, totally do so based upon the public information you could receive, they can respond accordingly. But also, they're going to appreciate the fact that you came in, had done your homework on them, and said up front, I'm not sure if I'm really a great fit, but now you're asking for help. And a lot of times these, angels are angels. They're going to know other people, and they're going to sit back and say, well, you're right. You don't fit me, but I do know John and Jim and Debbie who would be perfect for you. And I do that personally. I'll send people to others accordingly. The other thing to understand about angels is a lot of times they're going to act like they're making a nonprofit contribution. They're making a charity contribution, more so than even an investor. What I mean by that is if they're enticed, if they're intrigued, it's such a crapshoot. I just met earlier this morning with the head of Ohio Angel Group, and he said that of the 63 investments that they've made, 25 are dead already, 25 are walking wounded, and 50% may be working. But even then, he doesn't know about those 50. So the hit rate is so low on a generalized level that you really have to hit a button on the part of the angel. They need to be sitting back saying, God, I want to be involved with this. I put money into a craft bourbon company, for example, and the sole reason I did it was not because I expect to make any money off of that deal, but rather being part of a bourbon company is near and dear to my heart. So, you can get money that way too. So here's some examples. Investor A, modest risk, a show, seed stage. So Investor A, he likes seed stage mobile apps. He likes situations where $250,000 is total raise to get it to market with a $10K minimum investment amount, and he anticipates, when he looks at it, that he's going to 10x anticipated return. Where the next guy, Investor B, is a high-risk guy. He's a long shot. He wants to win. He's also seed stage, but he only focuses on med device, where he knows that the seed round is going to be $500K, that you have to put 25 in, but they're going to need to raise another $3 million to gain FDA approval. But he also knows that if they get through that hurdle and there's a higher risk, that it's not going to happen, but he's going to get a 40x. Met a angel with one of the local angel groups one day, early on his angel investing career. He hadn't yet figured out where he was going to be at. And so we had a sit-down coffee. We talked a lot about it. And about a month or two later, he came back to me and said, Glenn, it was good to talk to you about this thought process. So I've come up with the decision that I'm only going to invest in companies that are software as a service, that they're going to be at the A round, and that I think I'm going to get a 10x return. And what it did was create the filter for him. That's what you're contending with as a startup. You got to find those players who fit within your characteristics. Okay, so we have a little bit of time, just a minute here. I'll go real quickly. Convertible debt. Key negotiable terms are going to be, and I apologize if you need to look up convertible debt, please do, but it basically is a debt on the books that converts due to a specific event occurring down in the future. It typically is the number one method after your friends and family put in investment. When you get a third party in to invest in you, they're going to do it as a convertible debt round. The terms that you need to be aware of are conversion discount, interest rate, the 6%, 8%, whatever, the cap on the valuation that goes on the conversion itself, the dollars needed that have to be raised in the subsequent round, for automatic conversion on qualified financing, and what happens if we don't raise the money. I would highly recommend that you look up some articles on convertible debt, get to be very familiar with it, get to understand what different ones are being used, or the terms that are associated with it. So as you move out there with the angels, you already have a good handle as to what you're going to offer here. Was at a pitch event where two different firms got up. The first one gave convertible debt. There was no cap on the valuation. I asked a question. They said no cap. And I said, well, I will never invest in a company that has a convertible debt with no cap. The next group got up a little bit later, and I asked the same question, and they said, well, hearing what you just said, we're going to put a cap on the valuation. So it's one of those critical factors. The interest rate is not as important as a cap on valuation, but again, look it up. I'll skip this one. So minimum documents needed as you go out there. I typically suggest that you definitely have a one-pager, a very strong one-pager. It should have all the wow factors that are going to be in your pitch deck, your presentation deck. It's a fast way when someone says, hey, I'm interested, send me your one-pager, you've got it ready to go. There's no hemming and hawing, there's no delay time. The presentation deck should basically be an expansion of the one-pager. Some angels will ask, go right to the presentation deck, but some will not. To your monthly budget, I want to see that, even though I know that year two, and maybe even year one, but definitely year two, may be a bit of pie in the sky, or you really don't have a strong handle. But I'm looking for internal consistency on that document. And some angels are going to ask for 5-year projections. Personally, I don't agree with that because there's no way in hell you're going to come even close to what those 5-year projections are, but hey, so be it. A risk factor document. That's when you have a subscription agreement. You really need to have risk factors associated with investing in your business. The subscription agreement itself, of course, with the accredited investors, they have to certify that they are an accredited investor. Generally a shareholder or an operating agreement. If you've already formed your LLC, then you'll have an operating agreement. The investor is going to want to see it. I shy away from really draconian operating agreements that place all the power on the founders themselves. That's one that, again, I'll ignore or not even consider. And unless you use third parties or specifically advised by your attorney, a PPM is not really needed. Save the added cost. You're going to, if you go to a big name law firm, they'll write you a PPM for $25K, $50K, $10K, whatever. The reality of it is you don't need it. The documents before this are really the ones that are appropriate. So just summary, and then we'll open it up to the questions. Make your pitch a wow. Understand your strengths. Make sure team passes a hurdle of your potential investors. Your go-to-market strategy, fundraising must be in sync. All those things I put in. Target your investors carefully. I mean, I think it's absolutely critical. It doesn't. There's so many information sources on investors, what they've invested in, angel groups, what they invest in, what their past investments have been in, that you should be able to weed out the ones that really are not a good fit. The type and terms of funding is highly negotiable. Use expert advisors to ensure fairness to you. It doesn't necessarily mean an attorney. Attorneys don't necessarily have the experience. They have seen a lot of funding terms, but they don't necessarily know what fairness means for you. And so it's best if you get an expert advisor on board early to be able to understand where you are, the stage you're at, and how much money you're likely to raise. So I'm going to turn this over now to and introduce you to Anatoly, who's co-founder, CEO of ParadigmNEXT. Again, thank you, Anatoly, for hosting this today. Anatoly and his team have been looking at some of the questions. He is going to reflect those, and I guess I'll try to answer them.
Well, first of all, thank you for doing this, for answering a lot of questions that a lot of people have, a lot of our customers have.
Yeah, my pleasure.
So forth. Some of the questions that came up during your talk and some that are would people find the preferences of the investors? What do they invest in? What do they look for as revenue, and so forth?
Okay, so first off, if you're going to an angel group, most angel groups have a website that identify what their typical investment profile is. That's number one. You can also then look at, a lot of them identify what companies they've already invested in, and therefore you can see the type, style, et cetera. Now, they may change. You should call up the managing director of an angel group. Now, when you're dealing with individual angel investors, you ask around. When you talk to one angel investor and you're not a right fit for them, and you ask for a reference to somebody else, make it very clear you're looking for someone who fits your profile. When you're talking to other entrepreneurs who have been out in the marketplace ahead of you, and don't ignore that as an opportunity. Go to the companies that have been funded, that have $500K in funding, $1 million, $1.5 million, $4 million in funding, and go talk to the CEO of those companies and say, hey, how'd you raise money? Who did you raise money from? Is my model similar to the ones that you had, or do you know anybody that you talked to who you weren't a fit for, but I would be a good fit for? You'd be amazed at how often people are willing to share. Entrepreneurs like supporting the other entrepreneurs.
Well, to build on that, I guess, a little bit more, the best methods of contacting angels. So, obviously talking to other entrepreneurs, going to some events. So maybe you could suggest some events, some pitch events, and just best practices.
Yeah, so first off, if you've got your elevator pitch down, go to the pitch events. And when you're walking around, you're meeting people, you're going to figure out fairly quickly who's an angel investor, or you might identify who's an angel investor. Be prepared to have that elevator pitch, and I'm talking about 15 seconds. Get their interest, get them to go, oh, that's really interesting, and they may spend a little bit more time right there and then to talk to you, or they may hand you a card and say, hey, give me a call. Yes, other angels, of course. There's so many pitch events that the angels hang out at these days that you got to kind of go that route. But the other one is, it's a networking process. Do you have the guts? Do you have the capability of going and meeting somebody, have that coffee with them, and ask for 3 referrals, ask for 4 referrals? Unfortunately, it is as difficult, if not more difficult, than finding your first B2B client after you've created the product. You got to knock on a lot of doors. Besides the pitch events, there are places that the open doors that occur at, like 1871, for example. If you're in a specific field like Matter, then healthcare, for example, you go to there. It doesn't hurt for some companies. I'm not suggesting that everyone do this, that you actually do a pitch event. I'm involved with a number of different local pitch events as a judge, a panelist, or whatever. The biggest problem that I see at times is they are a shotgun. Out of the 30, 50 angels that might be in the room, 5 of them are relevant to you. But you know what? Sometimes that's the way to get the foot in the door early, get some interest level, and then use that to branch out. Again, the likelihood then is most of the people sitting in the room are not going to be relevant to you. Don't waste your time, and don't waste yours.
Got it. Once you're in the door, once you're actually talking to them, a lot of companies, startups struggle with showing revenue projections and showing revenue, and whether they have to show revenue. A lot of the unicorn companies out there raised funds without ever showing revenue, and just based on not even a promise of revenue, but just promise of growth. So how do you balance that, number of users versus revenue, and how do you present it properly?
So one of the biggest issues we face in Chicago is that somebody mentioned that we're kind of like a small ball venture capital here, small ball private equity. What they mean by that is you have to have revenue to raise angel funds. Fortunately, that situation is improving. You're able to raise funds prior to having to generate revenue. And since we were really talking about startups and seed stage, I'm going to presume in general that you are either on the verge of generating revenue, or you're just a little bit of revenue, or you're pre-revenue. So most likely you're going to have to put in some sweat equity and a little bit of friends and family money to get you to a point where you have a product that you can go out there and start selling, or that you're fairly close. But again, there's so much dependency upon the actual investor. When I went into a med device company and put money in, hell, revenue was so far out into the future, there was no need for them to project the next 3 years of revenue. What I wanted to see was what their budget was over the next 3 years, because it was all going to be downstroke money. So it's highly dependent. If you're doing a real estate play, a ground-up real estate play, guess what? They know better. They know you can't have built it, the development itself. So you're going to show projections, you're going to show costs, you're going to show the return on investment to the investor, and they're either going to bite or not bite. So it really is highly dependent. Unfortunately, in this kind of situation, I cannot give specific advice because it's very specific to the company itself, the type of company, the size of the company. You mentioned unicorns, Anatoly. Guess what? This town is hard for unicorns to develop because many of the investors do require it. On the other hand, there are some. There are some who are willing to take the bite at a unicorn potential. That means somebody who has to build market share with no revenue model specifically in play. You may end up having, if you truly are a unicorn, you may have to go to a coast, a VC or otherwise, or angel group.
Got it. Good question just came up right now from Bianca as far as what are your thoughts on crowdfunding platforms and how they can be used as part of the fundraising process, whether they can be used, to get an initial seed before you go to an investor, and whether they'll hurt your chances with an investor if you went that route.
I am a subscriber to a number of the different crowdfunding platforms. I use it for a couple things. One is, rarely do I use it for finding an investment, but I'm a little bit unusual in that regard. There are a number of different angels out there who that is their sole source of where they make investments. They use the crowdfunding platforms as their filter process to get it down to a more manageable number, and then they make investments accordingly. One of the things you can do is, and this is, you get a friend, you get a true accredited investor, whatever, to join one, you can actually see pitch events. That's number one. So you get a chance. Two, syndication. Really the cost is more on the angel side than it is on the entrepreneur side of most of the crowdfunding platforms. What I mean by that is a credit investor will syndicate a deal. They will get 10%, 20%, whatever position in terms of whatever the group they bring on the table on. The cost to the actual entrepreneur could be virtually nothing from what would have been a normal term sheet. So I've seen it work for certain companies. One or two of them are focused on the tail end of a round, the last $100,000 to $500,000 of a round. Some of them are better. Now, there's a difference between crowdfund investing, which I was just describing, and crowdfund the Kickstarters and Indiegogos and such. If you have a consumer product or something of that nature, then I highly, if you believe you can be successful on those platforms, then I do recommend that you go through that. As a matter of fact, if you can go through that before you start raising money and you're successful, it really does a major job on convincing angels to put the money in. If you fail on a crowdfunding platform, however, the due diligence is going to show that, and that'll cause me as an angel to be concerned about it. There was a recent entrepreneur who asked me about it, and I said, for your type product, I definitely would go crowdfund, but you got to be prepared to be successful, and if you do, then I think there's a lot of people who are prepared to invest. Okay.
And then last question is from me. I've noticed that a lot of investors won't really commit or say no at the end of a meeting. But very rarely will you hear a no from a VC or an angel. What is the best practice for discerning those, those soft no's from the hard no's, and for the subsequent follow-ups?
Oh man, that's a really great question and a hard one, because as a generalized rule, it's hard for people behaviorally to say no to someone else, right? And so you get the soft no's or you get the maybes. Maybes are a kiss of death for you. I think it goes back to almost sales techniques to a certain degree, which is, you're allowed to ask the hard question. When you get through the end of it and you're getting somebody, kind of waffling a little bit, ask the damn hard question. Say, look, I don't want to waste your time. If we're not a good fit for you, or you could ask it even, a different way of, what are the 2 or 3 things that I need to do to make this more interesting, more valuable, more attractive, right? And you'll see what kind of answers come back, and that may give you a better sense of it. But don't hesitate. Make it easy for the person to say no. In other words, do it in a way that if they're inclined to say no, that they'll say no. It really helps when you ask that kind of point blank question and they go, oh no, I'm actually interested. I really want to move forward and continue the discussions. And then you can say, well, what are the next steps, and what's a time frame by which you would normally make a decision on this kind of thing? What do I need to do, and what time frame in order to accomplish that? And that'll help you, because if they don't have a clear response to it, you're probably a no. If they have a clear response, it's probably like, yeah, I've done this before. I know what I need to see. This is how I progress, and within a month and a half, I'll make a commitment as long as you do X, Y, and Z.
Yeah, so seek that resolution at that.
Seek that, absolutely, no question. Be less concerned about getting somebody to say no. I tell my entrepreneurs who I work with, get to know quickly, and I mean N-O, a no, or a K-N-O-W, okay, period.
Got it.
Okay, I think we're out of time here. Appreciate everybody for attending today. If you missed something on this and want to revisit it, I think this is going to be posted on the ParadigmNEXT website.
It's going to be posted on the ParadigmNEXT website, so you'll be able to see the video as well as the presentation.
Okay, and I appreciate everybody's feedback. I really thank you for saying that it was a good session. I enjoyed doing it. Thanks a lot.
Thank you.
Take care.